welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. In global financial markets, no one has watched more closely than the chairman of the US Federal Reserve, Jerome Powell. And so it was when Powell spoke at the annual economic symposium at Jackson Hole, Wyoming, over the weekend, New Zealand time. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks, Powell said, confirming Federal Reserve interest rate cuts are just around the corner. To discuss this and more about what's going on in global financial markets, New Zealand financial markets in particular, I'm joined by Imre Speizer, Head of New Zealand Market Strategy at Westpac Institutional Bank. Hi Imre, and thanks for joining us.
Thanks, Gareth.
So firstly, Jerome Powell is obviously a great point to start this week. Those comments from him at Jackson Hole, was that what was expected from him?
You have to say not entirely, because the market moved. We saw the 2 and the 10-year move about 10 basis points, so that's not a trivial reaction. So the markets on Friday were surprised by Fed Chair Powell's speech, even though he didn't deliver any significant fresh news. He told us effectively that the rate cutting cycle would start in September, and that essentially endorsed market pricing, which was already in place. That said, whenever the market's pricing is endorsed, it gains confidence and it tends to add to those positions. So that would have been part of the reason why you got the rate move following the speech. I think the second reason was that Fed Chair Powell deliberately refrained from indicating whether they would start with a 25 or a 50-point cut. And markets were looking for some guidance on whether he would be moving gradually. Some of the Fed members over the last week have been using the word methodically. That essentially means 25-point increments. Or would he allow for something much bigger? Powell didn't mention anything about the pace. He said all options are on the table. And so with that, the market was also encouraged with the idea that a 50 is possible. It's not the most likely outcome, but it is possible, and therefore they have to allow for that and price it in. And so you got the reaction. I think those two things combined, the endorsement of pricing and the allowance of a larger move, were responsible for that 10 basis point reaction on Friday.
Okay, so that Federal Open Markets Committee meeting, that next one is September the 17th and 18th US time. So that's when they review, obviously, the federal funds rate, which is their equivalent of our official cash rate. So between now and then, given that Jerome Powell has come out and said what he said, what will you be watching for in terms of financial market reaction?
Number one, the labour data, assuming even more importance than usual. And the reason for that is in Powell's speech, he made quite emphatic mention about the labour market cooling more than they would have expected. If they got a big surprise in the labour market data, which comes out at the end of next week, we get the monthly US payrolls, and they're the main piece of labour market news that you get regularly. If that is very weak, for example, then I can see the market jumping into price and a much bigger chance of a 50-point cut to start the cycle. As it is, our own view and our US economists' view is that the labour market is cooling, but not severely so, not enough to frighten the Fed into starting with a 50. So starting with the 25 is our call. But that would be the one big thing that I would be watching is the labour data at the end of next week. If that's very weak, then market will price in the 50. If it's not so weak, then I think they'll stick with the 25s. Ahead of that, you'll get some high frequency stuff. You get weekly jobs data in the US as well, these jobless claims, and I think the markets will be watching that as well. They usually don't react too much to those weekly numbers, but given Powell made a big deal out of talking about the cooling labour market, I think the markets will be watching anything to do with labour data between now and the September meeting.
Okay. And where's that Fed funds rate at right now?
Right now, it's at 5.375.
Okay, so
Yeah.
obviously we had the Reserve Bank here in New Zealand, cut the official cash rate to 5.25% at its last review. We get another review from them on October the 9th. To what extent is what the Fed does likely to influence the Reserve Bank of New Zealand? And what are the markets currently pricing in terms of New Zealand OCR expectations?
In terms of influencing the Reserve Bank here, not so much. The Reserve Bank here is quite independent. It doesn't, blindly follow what other central banks are doing. It follows, the requirements of the economy, and particularly it's whether inflation is heading towards the target. So that is the number one thing. So, if inflation is seen to be heading towards target, which it is right now, it will continue with its rate cutting cycle, even if, for example, in a hypothetical world, all the other central banks just stop cutting. And in fact, some of them might start hiking. That wouldn't matter so much to the Reserve Bank. They really, follow the important economic factors as they see them, rather than the actions of other central banks. Sorry, what was the second question?
Market pricing for OCR expectations.
It's interesting. It's actually not too dissimilar from the US market pricing, in that they're priced in some chance of a 50-point cut here as well. So in both countries, in the US and here, they've got about 200 points of easing priced in over the next 12 months, just fairly aggressive. In New Zealand's case, they've gone a little bit over, and they've priced in about a 40% chance of a 50-point move at each of the next three meetings, so October, November, and February. And the terminal rate in both cases is somewhere around 3 or just under 3. So, pricing is very similar in both cases. So then you would say, well, if the two racehorses go neck and neck, that should probably be neutral for the Kiwi dollar, say. I don't think it will be, because the market will put a lot more importance on the US side of things. So even though the yield spread between New Zealand rates and US rates might not move too much, just the fact that the Fed is cutting aggressively will actually weigh on the broader US dollar. So you'll get the market selling the US dollar against all of the major, G10 currencies, and that will have a ripple effect into the Kiwi-US exchange rate. So, even though both central banks will behave similarly, I think the markets globally will put more importance on what's going on in the US, and therefore, if we see that US dollar weakening, which is our view over the next few quarters, you should see Kiwi-US, all else equal, rising a bit.
Now, in terms of wholesale interest rates, we've seen some big drops in local swap rates over recent weeks, obviously with the expectation of the Reserve Bank's official cash rate cut and the Fed moving, and then, of course, the RBNZ actually following through. Why do these swap rates matter, and how low could they go in coming months?
Yes, swap rates are very important in the New Zealand financial markets. They're arguably the most important interest rate instrument. Whatever swap rates do, other interest rates will follow. So, for example, if your 2-year swap rate went up by 100 basis points, you would find mortgage rates following suit, other business lending rates, bond yields, pretty much anything. They are the foundation of all interest rates in New Zealand. And the swap rates themselves are constructed by expectations of the OCR mostly. What the swap rates do in this cycle is important, therefore, for all interest rate users and therefore the economy. I mean, our view is that they will fall to, or the OCR itself will fall to about 3.75%. There's a range of views around that. There are some economists who think it might be closer to 3. The Reserve Bank itself thinks it'll get down to about 3. The markets think it might get down to about 2.75. They're essentially the most aggressive in the spectrum of participants. Regardless, the swap rates are going to fall a bit further. over the next few quarters. And that's simply mechanical. So even if views around the economy don't change, the markets have already priced in this whole easing cycle. So think of it as, they've priced in they know the OCR is 5.25% today. They believe it'll be well below 5% by the end of the year, and in a year's time, into the threes. That's already priced in. So as you move forward in time, those high OCRs drop out of the calculation of a swap rate, and you just mechanically end up with a lower swap rate. So even if views don't change, if nothing in the world changed, you would see, for example, that 2-year swap rate moving from its current rate of about 3.85 down towards somewhere in the lower threes over time. So that's just time and the mathematics doing its work. It's not really the market moving as such. One point that we've been making a bit lately is that because the market's priced in the whole easing cycle already, you don't actually have to wait until the 2-year swap rate gets down to the low threes if you want to, say, lock in fixed rates or do hedging, if you're willing to do things called forward starting swaps or forward starting loans. So these are quite interesting things, and they're quite available in the markets. It means if the market's priced in a lower interest rate in the future, you can take advantage of that lower interest rate. So for example, right now, you could lock in a 2-year swap rate starting in 1 year's time at about 3.25, which we think will be the low in the cycle anyway. So you don't have to wait the full year to get that. You can actually get that right now if you're willing to do a forward start. It's slightly technical, and you do need assistance with these things, but I thought it's just worth mentioning that in the context that the market has priced everything in, and the only way you can get lower swap rates than what these forward rates imply now would be if you get big negative surprises, particularly in the economic data. So barring economic data surprises, barring event surprises, and barring big shocks offshore, I think the forward structure of swap rates has probably found its bottom.
Okay. And obviously you will be, and as ever, watching the yield curve very closely. For anyone who doesn't know, what is this and what is it telling you at the moment, I guess, in New Zealand and separately the US?
Yeah, the yield curve is just a kind of a picture of the various interest rates for various maturities. So for short-term maturities, you'll have a yield. For longer-term maturities, you'll usually have a higher yield. You join all the dots for the different maturities and you get what looks like a yield curve. Now, the yield curve shape is important to users of interest rates, but it's also taken sometimes as an economic signal. So, 6 months, 12 months ago, in many countries, particularly in the US and particularly in New Zealand, we had a downward sloping yield curve. That is, short-term interest rates were high and longer-term interest rates were lower. Now, that shape of yield curve is quite unusual. Economists would say that sometimes that is a good predictor of an economic cycle, and a negative sloped curve predicts a recession. It doesn't work every single time, but in most economic cycles, that has been the case. In this particular cycle, we're thinking it won't be, or it won't have been a harbinger of a recession. We think the US will engineer a soft landing. There are many pockets in the economy which are still doing okay. In New Zealand, we're expecting very low economic growth, but again, we're not expecting to go into a recession either. So yeah, there were early indications from those yield curve shapes that we could have got into a recession. Where are these curves now? They're pretty flat. So the market's adjusted it to make short-term rates and long-term rates about the same. We get a very, very horizontal shaped curve. What does that tell you? Not much. It's quite neutral. It tells you that a soft landing in our economy and in the US economy is quite plausible. In time, we think the yield curve slope will steepen. That is, longer-term rates will be higher than short-term rates. And the reason for that is you usually have that when the Reserve Bank is cutting rates. So think of it as the Reserve Bank's cutting the overnight rate. Those short maturity rates like a 6-month or a 9-month or a 12-month or a 2-year, they will follow the OCR down much more closely than will, say, a 10-year rate. So naturally in an easing cycle, you'll get the steepening of a yield curve. And that steepening of a yield curve has implications for different, users, people who want to lock in fixed rates, people who want to hedge. And I won't go into the technicality of that, but it's important for them to know which way the curve might be heading.
Okay. Are financial markets confident that the inflation genie is back in its bottle?
I think they'd never be completely complacent. Actually, they'd be more, on guard for anything, whether it's to the downside or to the upside in inflation. Markets are very nimble. They're very responsive. The minute you get a piece of surprising data, they'll jump in that direction. So they're not really wedded to any particular direction. But right here and now, they're saying, well, inflation has looked like it's turned the corner. Economies are slowing. Labour markets are softening. Therefore, we should continue on a downward path in inflation. And that will keep the central banks in rate cutting mode. So that's where they are at the moment. But as I say, if you've got data going the other way, they would jump very, very quickly. Australia is an interesting case in point. The RBA there recently at their latest meeting said that they're nowhere near ready to cut rates. So they're quite different from the rest of the major central banks. I mean, they didn't hike rates as much to start with, so they didn't tighten conditions. They didn't slow the economy down as much as most other countries did. And that gives them the luxury of being able to sit on their hands for a bit longer. But they're certainly not in cutting mode. And our economists have adjusted the first rate cut timing from the fourth quarter of this year to February, currently, of next year, as the earliest juncture for a first rate cut.
Okay, yeah, the Australian cash rate's at 4.35%, which is obviously still lower than ours, even though ours has now had one cut to it. I guess looking over the next few months, I'm particularly thinking really here through the balance of 2024. Obviously, the central bank actions, here in New Zealand, the Reserve Bank and the big kahuna being the Federal Reserve in the US, are going to be key drivers of what happens with currencies and wholesale interest rates. Are there any other major influences lurking out there that we should keep an eye on?
Yes, indeed. And you're right to say that, yes, interest rate differences have been the big driver of exchange rates over the last year. Absolutely. We model these things. We regularly look at our models to see what are the main things in the model which have been driving the exchange rate, and it's been interest rate spreads, a clear number one. Going forward, they will still be important, but there'll be the other drivers which typically do move exchange rates over the long run. I think they'll start to be a bit more important than they have. So risk sentiment, for example. We've seen risk sentiment actually very recently assuming a bit more dominance. We noticed this, say, after the Reserve Bank cut its rate on the 14th of August, the first rate cut at the MPS. There was 2 days of negative reaction to that. Yields fell, the Kiwi fell a bit. And then after that, the Kiwi dollar picked back up again and it rose. And it wasn't really so much yield spreads driving that as there was a bounce in risk sentiment. So risk sentiment improved according to a number of measures like equity markets, some commodity markets and so forth. So that told us that, yes, the market is now taking a bit more or paying a bit more attention to these other things. So I think risk sentiment will be important. Commodities might start to assume a bit more importance. They have been almost of no influence at all over the last year or even two. But if very recently we saw dairy prices in New Zealand pick up quite a lot at the GTT dairy auction. If we have a string of those, I think the market will seize on that and go, yeah, okay, well, commodities are actually starting to pick up as well. We better price a bit of that into the Kiwi dollar. So I think there'll be these other things which have been in the background. They'll start to come to the fore.
Okay. There was a hugely popular government bond issue last week from Treasury's New Zealand Debt Management Unit. A total book size or I guess interest or demand of $22.7 billion for what was ultimately a $6 billion 12-year bond issue. I'm curious here, how significant is the interest at the moment from overseas investors in New Zealand government bonds, and to what extent can this influence the New Zealand dollar's value? And does it even have influence on wholesale interest rates?
Yeah, the interest in the government bond market, if you go back to a bit of long history, goes right back to about 2013-14. Prior to that, offshore investors had almost no interest. And the reason for that is that we didn't have many government bonds, we were running fiscal surpluses, we didn't need to borrow, and the government stopped issuing government bonds. So the market kind of died for a while, for quite a long time in the 2000s. And it wasn't until the post-GFC where there was a jump up in issuance required to revitalise the economy. And that's when foreigners significantly came in or came back into the market. The next big phase was post the pandemic. So again, we had to issue a lot of government bonds. The size of our market multiplied. And up to a point, a bigger bond market is seen as better by offshore investors, because it's more liquid. They shy away from very small markets because they don't trust the liquidity if they ever want to, get out in the future. So we've had a couple of jumps in issuance, and that has really put government bonds on the international radar where they are. We're now big enough to have made a number of benchmark indices, the main ones which global investors follow, like the FTSE Russell, which is probably the most prominent of the lot, but also a number of others. New Zealand government bonds are now in these benchmarks, and then therefore benchmark followers will, who replicate those benchmarks, end up buying government bonds, and whether they wanted to or not, if it's in the benchmark, they just follow suit. So yeah, overall, offshore interest in government bonds of New Zealand have risen substantially over the past decade or more, and interest is pretty high at the moment. Now, reasons why they would go in or go out over a shorter horizon right here and now are things like the interest rate spread. What are New Zealand yields compared to, say, US Treasury yields or Australian government bond yields? That hasn't been so good. They have shrunken quite a bit to not far above zero. So if you're making a decision based on that alone, you probably wouldn't be too interested. However, New Zealand government bond yields are now above swap yields. That is very unusual. It's usually the other way around. The government bond is considered a lower risk instrument, and economically that's the way it should be. But they've flipped around, partly because of this big wall of supply since the pandemic. They've flipped around, and now our government bonds yield above swap. So somebody could buy those, fund them through the swap market, and earn a positive carry. And that's quite attractive. So there's a compensating thing going on there, which I think really helps the interest in Kiwi government bonds, and partly explains why that 2036 issue was so successful. That book size, by the way, was a record. Of all of the syndications they have done, that is the largest ever. And the $6 billion actually issued was the second largest on record. So I think from the government's point of view, that's actually quite a pleasing outcome, and that's a good syndication. And it also reduces the funding task for the remainder of the fiscal year. So that they do these weekly tenders. They've got a couple more bigger syndications to do, but by issuing $6 billion in this one, it takes a bit of the pressure off the remaining funding requirement.
Yeah, it certainly is a massive amount, that 22.7 billion book size. You mentioned positive carry there. Now, I assume here you're referring to carry trade. That was something I was keen to ask you about. because particularly in the context of Japan and the yen, it's been in the news quite a bit lately. So what do we mean by a carry trade, and what's been going on in particular with Japan and the yen in this area?
Yeah, carry, just to go right back to the basic, just means if something earns you more than what it's costing you. So then you've got a positive carry, you say. There are situations where you could end up with negative carry, and you don't want those things because then you're just bleeding money every day. So people look for investments which give you sustainable positive carry. In the case of the yen carry trade, which has been in the press a lot, the yen has been a notable currency as part of carry trades because yen interest rates have been close to zero for a long, long time. So think of two pools of investors. You've got the domestic Japanese investors, and you've got offshore participants as well. The domestic investors, because of the very low interest rates in Japan, have tended to outwardly invest in higher yielding instruments. Take a really simple example. They might invest in a US Treasury bond, giving them 4 or 5% return. And what they do is essentially they're funding it by the 0% yen interest rate. They're doing that because they're selling their yen currency and they're buying a US dollar currency and investing that in a treasury bond. That's tantamount to them borrowing the Japanese yen and lending it to the US with a big 4 or 5% pickup. That's the carry. That's quite attractive. They do, however, assume currency risk. So these things work all very well until there's a sharp movement in the currency. So we saw that recently with the Bank of Japan. Even though it's signaled it for a long time, markets kind of didn't believe it. And when the Bank of Japan did actually intervene in their currency to strengthen it and raised its interest rate, only slightly, but that caused quite a ruction in the market because now you're actually got a loss. You now have a currency loss because that short yen position that you have to buy those yen back when you sell your treasury bond. You're buying that back at a much higher price. So that frightened a lot of people. Certainly, the domestic pool, there would have been some unwinding of investments related to that. The offshore pool, they kind of do a similar thing, but in a slightly different way. In a pure currency way, they would simply buy a foreign high-yielding currency like the Kiwi dollar and sell the Japanese yen and just sit on that trade. And then they fund and get the return on those two legs. So because they're now long the Kiwi dollar, they earn the Kiwi interest rate. If they're short the yen, they're funding it at the Japanese interest rate. Again, that's great when the difference is, about 4%. But then you get a Bank of Japan a set of decisions like we got, and that tells the market, we better get out of this because the Bank of Japan might do even more of this. So hence the volatility. A lot of these trades were unwound. It rippled through to, the end assets involved. There might have been treasury bonds, there might have been equities, there might have been even commodities, all sorts of things. And that caused quite a big bounce in the Japanese yen as well.
Okay.
So, we're not out of the woods on that one either. The Bank of Japan very recently has said, they're watching volatility. They don't like it, but signaling that there's potential for them to actually push up their own interest rate even further. They will be the only major central bank in the world which is hiking rates while the rest of the G10 is cutting rates significantly.
Yeah, it's an interesting story over there. What about China? I mean, obviously financial markets pay a lot of attention to China. It's the second biggest economy in the world these days, a very influential country around the world too. Are there any particular issues there that are on the radar at the moment?
Economically, countries like New Zealand and Australia, we're very outward looking, we're export countries, and China for New Zealand is extremely important as an export destination. So the health of its economy is important to us. What's different between Australia and New Zealand is Australia sells what we call hard commodities like coal and iron ore. We tend to sell soft commodities like dairy, meat, etc. And so the parts of the economy that we care about are different. Australia cares about the industrial side of the economy, Like, are they making infrastructure? Are they building buildings, etc.? They're the things that consume their commodities. We care more about the health of the consumer. Is the consumer in good spirits and buying our dairy products, or are they subdued and tightening up their purse and not buying ours? So we care about different things. The consumer side of China is not looking in great health at the moment. There's job security concerns, and they're just generally worried about the broader direction of the economy. And so their spending has curtailed somewhat, and we've seen that over the last year in our dairy prices. But as I say, very recently we've seen a bit of a pickup, so whether that's improving or not, too early to tell. The Chinese government is trying to engineer a pickup in the economy for both segments, both the industrial side and the consumer side, but it's the industrial side which has been the recipient mainly so far, and it's that consumer side which needs to probably be given a bit more attention and a bit more stimulus. So yeah, right here and now, it just doesn't look like the consumer side is very strong, and that's, I guess, a warning sign for the health of our commodity sector.
Now, obviously, raging away, there's a couple of major war zones, high-profile war zones, with the Russia-Ukraine war and the Israel-Hamas and now Hezbollah conflict in the Middle East. I mean, obviously, human tragedy and destruction is going on in those places. From a financial markets perspective, how much focus is there on these two events?
Yes, so the geopolitics features strongly in this category called risk sentiment. So when I talk about risk sentiment is affected by a number of different things, outlooks for economies, but also things like wars and geopolitical tensions. So they affect risk sentiment. Another phrase, I guess you could say, is it's synonymous with animal spirits. Investors like to invest in risky assets when they're feeling good about things. When they're worried, they go in the opposite direction. So something like, the Gaza war, just the more general Middle East tensions, that will weigh on risk sentiment, which is therefore negative for things like equity markets, commodity markets. It also weighs on risky currencies. So there's a whole spectrum of currencies which have different risk attributes. We think of things like the Aussie dollar and the Kiwi dollar and the Canadian dollar and the Norwegian krona, because they're very commodity based, they're very outwardly facing currencies. These are the riskier end of the currency spectrum. At the more safe haven end, you've got things like the Japanese yen, the Swiss franc, and the US dollar. And you might argue with the putting the US dollar in that camp, but it is considered a safe haven currency, partly because it's the only currency big enough in the world to take investments when there's capital flight out of a country. It's the US dollar and things like US Treasury bonds, which are the recipients. So if the US dollar is a safe haven currency, it actually rises during times of global turmoil. And the opposite happens when things are feeling good. So when sentiment is more upbeat and investors are optimistic and you don't have the turmoil, then the US dollar falls. So it's got that safe haven identity, which then, I guess, in turn affects the Kiwi-US exchange rate as well.
Finally, Imre, I'm going to put you on the spot and ask you if you can give us your best guess for where you think the New Zealand dollar might end the year against the US dollar, the Australian dollar, and say against some of the other currencies like the British pound, maybe the euro and the yen, where you think it might be going and tracking against them.
We've got a very slight upward trajectory into the end of the year. We've already had a bit of a bounce. We've got quite a bounce after that Jackson Hole speech on Friday. And I would have thought, 60. I did previously think 62 to 63 might cap it for the year. But now we're broken through 62, and that Fed cycle is going to kick off in September, and I think all eyes will be on that. I think that's going to be the main driver of the Kiwi-US and it could take it up to 64 by year end. So put me down as a 64 by year end for the Kiwi-US exchange rate. For Kiwi against the Aussie, slightly different story because you've got two central banks going in almost opposite directions. You've got the Kiwis cutting, you've got the Aussies saying, no, we're sitting on our hands. That's going to keep the interest rate spread in the Aussies' favour. On top of that, you've got longer-term economic fundamentals, which don't look like they're going to turn around anytime soon, and they're going to be well and truly in Aussies' favour, namely the twin deficits. So our current account deficit, our fiscal deficit. Australia has the opposite situation, that they're in surpluses and are likely to do for some time. So longer term, we have to be bearish on the Kiwi-Aussie and year-end targeting 89. You've got the Kiwi-Aussie going in a downward direction, the Kiwi-US going in an upward direction. Kiwi-Yen is probably going to go in a downward direction, and Kiwi-Sterling and Kiwi-Euro, who knows? It's going to be how quickly those two central banks, start their hike or go through their cutting cycle. The Bank of England, for example, sounds like it might be the most reluctant to cut much at all.
Okay, that's great. Look, much appreciate that, Imre. That's Imre Speizer, the head of New Zealand Market Strategy at Westpac Institutional Bank. And I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.